Here is a controversial take. I believe most people pay way too much attention to interest rates, both in traditional finance, but even in crypto, oddly enough. People follow those meetings very, very closely. They're wondering, how much longer are we going to stay at certain rates? When will rates come down? Could rates increase again? I don't believe it has that much impact on asset prices long-term, actually. Academically, right, when you just follow the financial literature, then it obviously does have a lot of impact. Because the idea is that you have to discount future cash flows. So a stock or property, right, the reason why it's got value is because it has cash flows. So for stocks, it's dividends. For property, it's a rental payment. For bonds, it's a coupon payment. So you get your future cash flows. And the value of those assets is simply just the sum of those future cash flows. Now, the reason why the interest rate apparently is so important is because you have to discount future cash flows. So in other words, the further a cash flow is out in the future, the more you have to discount it. And you have to discount that with a rate, right? And partially that rate consists of whatever the Federal Reserve sets, right? You've also got some kind of risk adjustment, you've got a growth adjustment, but in the end, the base rate is what dictates pretty much the discounting for all cash flows for all assets across the board. So in theory, if you're raising interest rates, you have to discount those future cash flows more, potentially reducing the prices of all kinds of assets. And we do see that impact quite heavily on the bond market, but we don't see it as heavily, say, on the property market or on the stock market. What I also find very interesting is that what one would expect in terms of interest rate sensitivity regarding different stocks is actually not what we see in reality. So what we would expect is when interest rates go up, that especially the stocks that have most of their value far out in the future, they should be suffering the most. So technology stocks, they don't have a lot of cash flows today, maybe even zero cash flows, but we expect as they grow, as they become bigger, that at some point they might pay very large cash flows, right? Microsoft hasn't paid cash flows for decades until they decided to do so. And so we're simply just buying those tech stocks because we believe at some point they will be large enough, they pay cash flows, but they're far out in the future and they are very large cash flows in the future. What that would mean in turn is that when interest rates rise, that those cash flows that are very far out in the future, they should be discounted more. And that the stocks that don't have that effect, right, that have simply just very stable, reliable dividends, like let's say a Coca-Cola, we shouldn't discount it that much. So when interest rates rise, what would in theory happen according to financial theory is that the Googles of this world, the Microsoft of this world, they would crash massively, similar to long-term bonds, but the shorter duration things, right, the short-term bonds shouldn't crash that much, but the Coca-Colas also shouldn't crash that much. So in other words, the relative valuation of, say, the S&P 500, general US economy, it should outperform the NASDAQ whenever interest rates rise. And vice versa. Whenever interest rates go down, we should see that technology stocks outperform the S&P 500. Now, when we just plot this, right, even with a bit of a time delay, and we think like, okay, maybe there's some anticipation effect here. If we plot this on a chart, like on this one, right, how much connection do you really see in the relative performance of stocks, of tech stocks to regular stocks? I don't see much of a connection. So people are overestimating the effect of interest rates on stocks. People are also overestimating the effect of interest rates on property, right? Interest rates are sky high, property prices are not coming down. Will this change at some point? Maybe, if interest rates are sky high for long enough and people aren't afraid anymore to sell their house to go into a new house because now they're locked in those lower rates, right? They're not selling their current house to move and then pay those higher rates. So supply is somewhat contracted. That's why prices of properties stay high. If the interest rates stay high for long enough, maybe the effect will follow through. But why then take so much effort to try to anticipate the interest rates when their effect is so long in duration? It's not that important in the short term. It's not that important for the valuation of stocks, because otherwise we would see that differential way clearer. It's not that important for properties. The only asset that's really heavily influenced by interest rates are the bonds. but how many of you really have direct exposure to long-term government bonds, right? For the insurance industry, it might be interesting, but for the private investor, it's very uncommon to hold bonds, long-term duration bonds, right? It used to be relatively common, right? There was this 40-60 portfolio where people thought, okay, there's maybe not so much correlation between stocks and bonds, so you want to diversify, you want to own both. And so the older generation might have some pure bonds in their portfolios. But the people, say, below 40 years old, they might not have that many bonds. I have 0 bonds, and I'm very happy with this, because when you actually look at how this works, right, this is a bit of a parallel to crypto. In crypto, you've got this concept of staking, right? You lock up your crypto tokens, and you stake them, and you get more crypto tokens in the future. Now, very often staking gets paid simply by token dilution, as in more tokens are floating around, and so simply because the base of token expands, you will have more tokens, and you get those more tokens by staking. So you're really not gaining much if everybody is staking. If only a fraction of people are staking, then of course you might be gaining something against the people that are not staking. But how is it in the fiat world, right, with those bonds? You do get your bond coupon payments, but how fast is monetary supply M2 expanding? It's by 6.5%. So if you have a bond that pays less of a coupon than 6.5% per annum, then you are losing. And most bonds, long-term bonds, were sold below those 6.5%. So it's really just another tax on the people that are saving in bonds. If you hold bonds, if you hold US debt or any kind of government debt, it's very likely that the money expands faster than your coupon payments, and that in the end you will actually lose purchasing power over buying something that appreciates with time. So the real thing to look at is really demand versus supply, right? That's why properties are still high. That's why tech stocks outperform the rest of the market. It's simply people want to buy something that long-term outperforms. Tech stocks are that thing. And so even though we should be discounting the cash flows more with rising interest rates, the prices don't really come down. People don't really care about the academic literature here. I believe looking too closely at those interest rates is a mistake if you don't have a lot of debt, if you don't finance your property, etc., and if you don't have like huge leverage on something. If you're simply just investing and you take it somewhat harmless with leverage and you don't have, say, 90% of a property portfolio in debt, then interest rates really won't affect you that much. It won't impact asset prices that much. It only has a real impact on the bond market. If you disagree, then please give a comment down below. I'd like to hear your arguments. And if it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well, of course. It helps the channel grow. Cheers.